Yo, what's happening? So, something I definitely want to show you guys. First off, before we get too far into this, let's look over here. And coming up soon, you can go, well, actually, you can right now. You go to quitjerkingoff.com and it's slowly opening. Okay, so Red Economics, it is available right now. So we got the ebook. I believe it's going to be out anytime. You can pre-order the book itself. It's released on the 13th of January. It's Pop's birthday. Happy birthday. So you can at least check out some things right here. You get access to other books that's been written. You get to read some of the things that other people have said about it. So cool stuff I want to share with you. What you can also do, not that I know I'm moving around kind of quick here, go to Amazon. So that's also available over there, which is kind of cool. I had oh, going the wrong one here. Let's go Red Economics. I had a person tell me they got that order done. So there we go. You got the Kindle version. There is going to be a release coming out where you get this Kindle version at a substantially different price. So we'll let you know when that goes on, but it is available. So free delivery January 16th on this. So kind of cool. It's finally finally getting there after years of working on this. So very, very, very happy that that's finally occurring. Now, let's get into things that's going on with the market. So you've had the Fed lowered the rates today, which was anticipated. There was a time there people thought, nah, he's not going to. Then all of a sudden they do. So the Fed lowered the interest rate that 0.25%. Had a monster effect the day that happened. So we were talking about that day of where it was going to go and what was going to end up happening. We're starting at a very, very low point in the market, and then bam, it rocketed off, and everything did very, very well. So I'll share with you what that looks like, so you guys get a good idea on what's happening in the market at that point. So that was substantial what we're dealing with here. Actually, let me see here if I got that share correctly. Okay. I think it may have bounced into the wrong thing. Okay, so here we go. Here's what we got. So you've got this is our line I'm referencing here, and I'm probably going to zoom in a little bit more so we can see this, and you guys can get a feeling of what I'm talking about here. So this is the Fed, the day the Fed kept the rate. So right, we had opened really low. We are starting on this, basically on this moving average, and then it fired up to hit all the other moving averages, tried to break through it, and then peeled back down and settled on them. So then we had the following day, broke up yesterday, come above, but today opened and dropped low. Why is that? We got to understand what's driving the market. What's even having it take off the way it did? Because you look at all the other Fed rate days that cut the rate and take a beating, cut the rate, take a beating, cut the rate, started low, came back up. But they're all kind of ending in a similar spot. Look at this right here. If you draw this line, which I got to get to where I can draw it here. I got to move my chart around. Sorry about that. So I'm just kind of thinking as I'm talking here. So if we're looking at this is where it's landing right now. So this is where it is presently. It's kind of close to where those others are. They're all going within that same range. It's kind of interesting to look at that range of where it is, and the Fed cuts the rates. It ended at a spot, got close within the range. There it went up. And in fact, the wick hit this one, which is interesting. This wick here hit here. So there says something about the value of the security, depending, just period, with what's happening in the market. Now we open up about a little bit below where that wick was, and it gets hammered down. Now, Fred, Powell had the press conference that he called. He always does to talk about what he's explaining. And when he referenced that they stopped the quantitative tightening, and they're going to, not basically let things as it matures roll off their balance sheet. They're going to be putting stuff back in. Not necessarily is that a full balls quantitative easing, that it was taken by the market that if the Fed's going to be buying securities again, even if the Fed's calling it reverse management, it's adding liquidity to the system. So it lowers short the term rates and pushes even MBS prices went up as a result of it, because they're like traders are feeling, I'm guessing, that maybe this is some more quantitative easing, because we know what happened when they did quantitative easing before. Tons of money flooded into the market. So, and he's trying to get it towards a neutral range is what he's claiming, even though the market's my thought process is here. As I read everything that they had said, I'm reading some of the stuff that's over here, but it really boils down to The market is trying to interpret what the future is going to be and get ahead of it, more or less. That's what we're seeing going on here. But there's also a certain value within the market that is going to draw dollars to that specific point, which is what ended up happening here. So I don't believe that we're going to see, unless the Fed comes out and says we are going to do full-on quantitative easing, buying MBS and treasuries. Right now, they're only talking about treasuries. That's where their focus is. For any sort of liquidity that goes into markets can come through the treasury route, which isn't directly affecting mortgage-backed securities, except for the way the MBS buyers may interpret things, and they shove money into the market. So right now, we've gotten to I think our peak point. We've come back down off of that. We'll see what the future brings, but you're going to hear rates went down because the Fed had lowered interest rates. There's where it was. That's all it did. It literally reversed what happened the day before, and then we're heading back into that little bit negative territory. So look at that range again. I'll share that with you again so you can see the range we're talking here. This is the range that I'm seeing. We've got this much gap that we can work with. So we've got these moving averages here. We're kind of bundling up all the way down to this moving average. That's where our range is going to be, I believe. So that's 25 basis points to be 0.25% in cost. So whatever rate you may have been quoted yesterday, you could see it go up into the cost for that rate, 0.25% over the next few days of trading. I don't believe we're going to see, I believe we're probably building a bit of a ceiling right here, and I don't know that we're going to get back up in here. Just my guesses right now. But if you look at how the market's reacting, market reacted, a lot of money went in, and now it's like, oh, we're not sure if we're in the right spot after seeing how the rest of the market is digesting it. So lower interest rates may not be ahead anytime soon. Possibly in the future, we could go to the top of the range of that channel, from the day they purchased or started announcing quantitative easing way back in 2008. But we're staying in the whole trading range of that day right now, and we're right down the middle of it. So that's what I'm seeing. If you've got a deal right now hinging on the interest rates going down, and it's not going to work if the interest rates are going to go down, then you don't have a deal. I'm sorry. If you've got a deal in front of you that's cash flowing, but you're trying to cash flow another $10, guys, close the deal and move forward. Why are you worrying about that $10? You waiting on that deal means you could possibly get in a worse situation. If the deal works, if the tenants pay for the property and you pocket anything, you are winning because they're paying off the mortgage. Now, if you're putting 20% down, just paying off the mortgage is 13% growth. If you've got, say, another 5% you put into the costs associated with it, now you're 25% in the transaction, and the paying off your mortgage is going to put you at about a 10% increase year over year. If the property will appreciate at 2.5%, at least, that's another 10% on your 25% investment, which is 20% down plus 5% in cost. If that is happening, you are winning over 20% regardless of your cash flow. If you're wrapped up in the cash flow piece of it, you may not have a deal. Period. If you're questioning this, talk to me. If you're worried about this, talk to me. I'll guide you through the steps. If you have not looked at how to fully protect your family if something happens to you tomorrow, so they understand exactly what you've done, all the structure you've put in place, all the work you've done to try and make sure you have the right asset protection, that you've got the right entities in place to hold all these assets, and they don't understand it, and you're worried about being one of those type of people, if something happens and all of a sudden it's lost to either probate or mortgage payments that get unpaid, taxes that get unpaid, and all this effort's gone and your family didn't benefit from it, you might want to reach out to me. We got to talk. I've got all the things that put your mind at ease so you can go forward and knowing that everything's handled. And if something happens to you, your family's taken care of. If you don't have if they don't understand where it is, if your children and your wife or husband or other spouse, period, doesn't know where that information's at and doesn't know exactly how to access it and can see it and understand it, then you're not set. Call me. I will get it taken care of for you very, very simply. Talk to you guys soon.